Okay, so inventory turnover ratio. This is another fun one. This is one where the management majors, especially the marketing majors, you guys are really, you'll see this one a lot in your careers. Okay, this one tells us, how many times on average do we sell our average inventory? Okay, the higher turnover ratio tells us that we're selling inventory quickly, and managers, marketing people, they may want to look at specific metrics to see why. Okay, is it a seasonal thing? Is it a price thing? Are you priced too low when compared to the rest of the industry, so people are coming to you and buying? What you don't want to see is people coming in and buying your product and then reselling your product for more, right? You want to be the one making that margin, not people coming in and making the margin off of you, right? So these are the kinds of things that you would look at as a manager. Why are these things selling so quickly? Typically, you want this ratio to be fairly high, but if the ratio is too high or extremely high, it says, it could really indicate that in the future you may be losing out on some sales because you may not have enough of this in stock to sell. You may not have enough supply to meet demand, right? Very basic economic concept. You may not have the supply to meet the demand. Okay, so just keep an eye on this kind of 3.8 seems fine, but what if it was 25 times? Well, you may not have enough inventory in stock to meet the demand for the next period, right? You may need to go order more. You may need to raise the price. You may need to, kind of artificially manipulate that demand. So the next one is average days in inventory. How long does something sit on your shelf, right? That's kind of the measurement here. How many days does it take to sell the entire inventory during the year? How long does our inventory just sit around before we sell it? Okay, so the shorter the better here, the smaller the number the better, because what are we trying to do? Well, we consider inventory to be a current asset, meaning we expect to sell it quickly. We expect to turn it into cash fairly quickly. So we really try to minimize the days in inventory. However, this kind of goes back to that first slide where we talked about you need to know a little bit about a lot. You've got to understand how the industry works. Early on in the semester, I think maybe not even early, but I think in chapter 7, maybe we used the example of Best Buy versus Tiffany, right? Best Buy being an electronics store. I mean, they sell some higher end items. You can buy home theater systems that are thousands of dollars, that kind of thing. But typically people are going in there and they're spending a few $100s. Whereas Tiffany's, you walk in and you're spending thousands and thousands of dollars. They are high-end jeweler. They're selling to a very specific clientele. So we would expect of the two of those that Tiffany's probably has the higher days in inventory, and 96 days may be a good number for them. It may be a good figure for them, while for Best Buy, 96 days is probably not a great figure. They probably want theirs much lower than that, right? Because they're selling cheaper inventory that should be convertible to cash more quickly, okay? So just be aware that really it depends on the industry, what your number should be, okay? The current ratio, we talked about, this is one of the more important ones that like lenders, creditors are going to look at. All right, it basically just tells us for every dollar in liabilities I have, how many dollars do I have in assets? Okay, so the higher the current ratio, it usually means there is less risk, right? It means the company is typically less likely going to run out of current resources that they can use to cover their current obligations. But one thing to note is if you do have a very, very high current ratio, it's not necessarily a good thing. Okay, it could mean that the company's having trouble collecting the receivables. It could mean that they're holding on to inventory too long because, what's our numerator, right? It's current assets. So if we have current assets and we've included inventory, but that inventory is sitting there for 2 years, but it's still part of our inventory, right? We've increased our asset number, but we haven't changed our liability number. So that impacts the ratio, right? So one thing that analysts will look at is if a company has an increasing current ratio with either lower receivables turnover or lower inventory turnover, right? So that just means they're not collecting receivables, they're not turning their inventory over, but their current ratio is increasing, right? They've got more assets, they're just holding on to too many assets. But this one looks pretty good, 1.7 to 1. So for every dollar in liabilities, they have $1.70 in current assets. So they've got plenty to cover their current liabilities, plenty of current resources to cover their current obligations. Now, the other one that we'll look at is the acid test ratio, which is the same thing, just a little more refined. So the acid test ratio is very much like the current ratio, except all we're going to add here is cash, current investments, and accounts receivable. Those are the only current current assets we're going to include. We don't include things like inventory, right? Because really, inventory could sit there for 2 years, become obsolete. We can't sell it. So here we're only looking at the things that we really think are going to be turned into cash very quickly. Cash is obvious because it's cash. Those current investments, typically we're looking at those cash equivalents, those 90-day turnarounds, right? And then AR, we expect good policies. We expect to collect most of our AR, right? So that would be net AR, not your gross AR. It would be net, so your AR less your allowance. Okay, divide that by your current liabilities, and that gives us a ratio. Here we can see that VF has a 0.921 ratio, meaning that for every dollar in liabilities and current liabilities they've only got 90 cents in those highly liquid, easily convertible assets. Okay, so this would give us some concern because we can see they don't have current assets that are easily convertible to meet current liabilities. So we might be somewhat concerned there. Okay, but again, I would take the current ratio into consideration as well, because it's like, well, yeah, they may not be able to sell them as quickly, but they've still got some they could sell. Finally, we're going to get to the valuation part here. This is your times interest earned ratio, right? So this basically just tells us how many times over could the company pay their interest expense in the period. For this, note we're adding back our interest expense and we're adding back income tax expense, okay, into our net income. This is our earnings, right? This is kind of what we call earnings. This is what we've earned. This is what we have a right to use. We would technically have all of this available to pay our interest expense, right? So what this tells us again is how many times over could I pay my interest expense in the period? Well, VF looks like they've got enough net income that they could pay interest expense 8.9 times. Okay, that's a good thing. That does not concern me very much. Now, if we look at Nike's ratio, they've got a 20-to-1 ratio, right? Again, not shocking that there's that much disparity there, because Nike is a much, much, much larger company, right? I mean, think of it this way. You didn't have to Google what Nike was. You can close your eyes. All of us right now close our eyes and we can picture exactly what that Nike logo is. We know exactly what Nike is. However, VF, I would almost be willing to bet that almost all of you would have to Google it if I had not told you early on what VF was. So we're not surprised when we see that Nike's ratio is much, much higher. Okay, they are generating much, much more income. And that's why we use these ratios, so that we can compare these two different kinds of apples. They're still apparel companies, but there is an economy of scale that is unbelievably disparaging, right? So finally, we've got the debt to equity ratio. So for every dollar in equity, how much interest-bearing debt do you have? Here we can see VF has $1.45 basically in interest-bearing debt for every $1 stockholders' equity. Nike's is slightly higher. This is one area where they're doing slightly what we consider to be slightly worse, right? VF is beating them in this area. Well, to be fair, let's again think about the economies of scale. This is not concerning to me. This would not be concerning to me as an investor, because I know Nike's not going to have a problem covering this, right? They don't have an issue here. Is it higher than VF's? Yeah, but there could be any number of reasons why. Does it technically mean that they may be riskier in the long term? Yeah, but not enough that it's going to change my mind. Not a material amount, okay? And then we have price to earnings ratio. This is the last one we're going to talk about. This is your PE ratio, your price to earnings ratio. So it compares the share price of the company with its earnings per share. If you remember, earnings per share is that number we calculated in the income statement at the very, very end, right under net income, right? Your EPS, your net income divided by the number of shares outstanding. And that gives you your earnings per share. Okay, so we would take our stock price. What is our stock price on the market right now? And we would divide that by our earnings per share, and it would give us a ratio. So VF has a ratio of 34. Nike has a ratio of 60.5. Now, what this ratio does is it kind of tells us what is our, as an investor, what is your expectation of this company? What is your expectation on earnings of this company? Well, the higher this number, the higher your expectations are. And we can see here clearly there's a higher expectation of getting a return or getting a satisfactory return when you invest in Nike than there is when you invest in VF. This could also tell you that maybe VF is a higher risk investment, and the higher the risk, you would expect the higher the reward. But again, these are all questions that you're going to ask. They're all very high level questions, and you will start digging in and drilling down to find the answers for those. Okay, so these are all the ratios you have. What I'm going to do, and I will know who's watching these videos based on who emails me this question, because I guarantee you people are going to email me this question. What we're going to do for the cheat sheet this time around is I am going to provide you with a formula sheet. This formula sheet will have all the ratios you need to know for the exam. It will also include a couple of other things that I feel like you might want to know. Okay, that is yours to use. However, on the other side of that sheet of paper, when you print it, you are allowed to write down whatever you want. Okay, so one sheet of paper are the notes I'm giving you. The other side of the sheet of paper are the notes that you can write down, and that will be your quote-unquote cheat sheet for this exam. So those of you that email me asking, what are we doing for a cheat sheet? I'm going to know you have not watched the videos, and I will just email you back saying, have you watched the lecture videos? So any other questions, just contact me. As always, pretty happy to help you guys when you need it. So let me know.